No sound from the board.
You're listening to Ron Siegel's Home and Finance Radio Show, only on Financial News and Talk. Now live in studio, your host, local and national real estate expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots, you know, the actions you can take, how your family or business can benefit from current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We have a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. And let me remind you, if you ever have any home or finance-related questions, I am the consumer advocate looking out for you. And you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan, a plan to save you money, I am the one to talk to. I talk to you first. So give us a call again, 800-306-1990, 800-306-1990. Well, hey, you know something? We'll get right on it because I got some questions coming in. StreamYard.com/Facebook. Go to StreamYard.com/Facebook. Give us let us know who you are so we can actually have a chat with you. If you've got questions, comments, thoughts, put them in there and I will get to them. I see a couple of them already. I will answer those in just a second. So go ahead and put those right into the stream. As you know, we record every morning, 9 a.m. The broadcast then goes live on ABC News and Talk AM 1490 KMET, 6 to 7 o'clock in the afternoon. And on Wednesdays, we actually do two broadcasts. We do our broadcast at 9 to 10 for the ABC News and Talk Network. We then go and do a second program. We start broadcasting that at 10:30 right here. And that's for our Sunday show on Go Country 105. So go ahead and put those comments in there, and we're more than happy to chat with you about those. But hey, before we get into our intriguing content, let's take a look and see. We got some celebrations today. National Bavarian Cream Crepe Day. No cream. National Bavarian Crepe Day. I don't know if that'll do any good for my diet, but it looks good. And I'm looking at that. That looks really good. There's nothing to say more about that one. That's very, very good looking. Is it chocolate? It looks like on there, Nutella on that, or whipped cream maybe inside. I better stop drooling over here and get back to the broadcast. What else are we celebrating today? We've got National Goof Off Day. Those of you that know me for any length of time know that I am extremely good at this. Goof Off. West Virginia Day, National Ag Day. Well, that's we're going to need some of that. But here in the formerly Golden State, we like brown here, so I don't know about some of the ag going on. 3D Day. I don't know. Let's move right along and see what's going on. Dow Jones Industrial Average up 244 points. The S&P 500 up 46. NASDAQ up 244, which is very odd. Oil down $1.91 a barrel. Gasoline, do we want to look at that one? That's a scary subject. Our tremendous underwriter, Lori, 404.6. Our production partner. She does a great job for all of the families that we're serving. Jody's in Arizona, 461.6. Lori's in Louisiana. Josh is getting sick along with us in California. He thought he escaped California. I mean, he's a Californian, left to try and go back to America, wanted to raise his kids in the United States instead of California. $5.14 a gallon in Arizona. And in California, we're at $5.86.6 is the average for the state of confusion. $596.8 in Orange County, LA County, $6 and a penny. 601 in LA County. Elections have consequences, and some of you don't believe that Joe's he said he wanted to do this. He told us that when we elected him. Amazing. What's going on in the world? So let's get to our Facebook user. Do you think rates will keep going up, and will home values keep soaring? Yes. Yes. To sell or not to sell? That's the question. Don't want to be homeless if I sell. Well, it does cost a little extra to have a roof over your head. So rent or sell. But here's the issue. The prices are going to continue to go up. Now, I shared this with some folks earlier, and I'm going to, Josh, can you pull up that recession slide for us? So in the last 4 recessions, real estate has only gone down once, and you're not going to believe which one it is. Because a lot of people say, well, in the recession of 2008, real estate values dropped 19.7%. No, they didn't. Here's the issue. The 19.7% drop in real estate values caused the recession. So the recession was not the cause of the problem. But if you look back, it was 1980, I think it says, was the recession where real estate values actually dropped 1.9%. Now we are on the way to a recession. I'm going to tell you that. There's no question about it. We are on the way to a recession. Why? Well, the government's not going to spend $5 trillion extra this year that they did the last 2 years during the pandemic. That's not going to get through. So that right there alone, the interest rates are going up. But what happens when interest rates go up? They cause a recession. Federal Reserve always overdoes it. It's kind of like, you go to a good restaurant and you order a steak and it comes out well done. And, you want it at medium or medium rare, and they bring it out well done. You send it back and say, this is no good. And then they bring it back and it's bleeding. It's red, raw. Well, they overdid it on the well side, then they overdid it on the uncooked side. That's what the Federal Reserve does every single time. And Jerome Powell came out and said it yesterday that he's going to do everything he can to curb inflation. Well, the problem is he didn't do that soon enough, and now he's waited too long. Yes, inflation is here. If you're looking at gas prices, our state of California does not want to help. All they could do real quick is put a moratorium on gas prices. That'll save us about 60 cents a gallon in California by just doing that one thing. Oh, no, they want to send $400 to every taxpayer, even the ones that don't drive. How's that going to help with gas prices? Even the ones that have the electric vehicle. Oh, that won't help with the gas prices either. That's one resolution. There was another one out. I mean, they're so stupid in California. I mean, the legislators, unbelievable.
Such an idiot.
Yes, I
idiot.
know.
Such an idiot.
Idiots. So if rates keep going up, will values go down, or will the market slow? Well, neither. Values are not going to go down because there's such pent-up demand. There's still people that are out there shopping for houses and losing out on bids. I see them losing on bids on $400,000 houses, $600,000 houses, $1 million houses, $2 million houses. The highest I've seen a bidding war on is $3.5 million. So they're all in bidding wars. Well, there's only one of those properties. All the other people lost. And many of them are qualified. Now, they may not, if they were qualified for a $1.1 million house, they may be only qualified now for $1 million house because of what rates have done. But they're still out there shopping. They don't want to live in the basement anymore. And there's still people turning 33. If you look in 2008, and I'm not going to do the math on air because I don't want to prove how foolish I am. I was often taught, if you say nothing, people will think you're a fool. Open your mouth, remove all doubt. That's where I'm at. So in 2008, there was actually a decline in people turning 33 years of age. 2007, there was a decline. First times that we've seen that happen. Why is that important? Well, the reason is that's when we find young people start buying their first homes at age 33. There are still boatloads of people turning 33 for the very first time. Well, no, you don't get to turn 33 twice, right? So there's still a boatload of people turning 33 years old. So as that continues until about 2026, I think, is what the chart shows when we start seeing the next decline of people turning 33. That might be the time when we could see some more inventory on the market, when we might see some more supply. As long as there's more demand than supply, rates will continue to go up, even though the interest rates are going up. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. When we come back, many benefits of home ownership. We're going to talk about that. When to consider a cash out refi. We'll get into that as well. And understanding mortgage options during divorce. All that and more. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or ronsiegelradio.com, facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio, your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. In every market, there are solutions, as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for the next home loan, Geneva's got the programs and the products. You've got the phone. Make the call, 800-306-1990. Operators are standing by. Dow Jones Industrial Average now up 226 points. The NASDAQ is up 229. Interesting right there. Well, I'll tell you why I find that so very, very interesting. S&P 500 is up 47.92 as I look at it right now. Actually, 43.35. It just ticked. 10-year Treasury is up 6 basis points. Mortgage-backed securities are down 27 basis points. Why did I find that interesting? Well, generally, when we watch the 10-year Treasury going up, and it's been going up dramatically lately, well, we usually see the NASDAQ, the big tech companies, are dropping. It hasn't followed through this time, so it's unique. Although we watched, they don't always go together, but recently, that's really been what's happening. Is they've been really moving right along together with when the 10-year Treasury goes up, we see the big tech drops and vice versa. So we're watching that, and I'm watching one of the bigger techs, Apple, up $3 right now. So moving that, and again, no financial advice here. I'm just reading the numbers for you, sharing the numbers for you. And as I mentioned, we've got the 10-year Treasury, the bond is down 27 basis points. And I report this on a regular basis for you. OBMMI, they are the locking mechanism, Optimum Blue Mortgage Market Indices. Gives us rates that were locked yesterday by the largest of the loan origination software companies for mortgages. We have a 35% market share of all mortgage transactions nationwide. Loans locked yesterday, 4.601. 4.601. The 15 years, 3.761. Jumbos, 4.167. And 30-year FHA loans locked at 4.568. That's where the numbers were yesterday. So we're going to share this slide that we have. Our team makes these great slides So we'll share this for you on our social channels. Got to just put on the data and sourcing, but we got to make a little modification there. But take a look at these numbers. That's where loans are locking at. No matter what they tell you, no matter what you hear on the radio, on TV, all the teaser numbers, this is what's legitimately happening with 35% market share yesterday. Okay, and you can see that chart. It's just gone straight skyward. So we'll share this on our social channel so you can actually see what's going on. That's the mortgage. Well, let's find out why it's going on, I guess, is really what we should do, right? Why is all of this stuff happening right now? Well, I told you the Federal Reserve came out and they made comments yesterday, said this is supposed to be one of the brightest people that in the banking sector. Jerome Powell, yesterday, in his testimony, inflation is much too high.
Surprise, surprise, surprise.
Does that surprise anybody? I mean, thanks, Jerome. We didn't know that. We didn't know that those gas prices were going up like crazy. Pledged to take, quote unquote, necessary steps to bring prices under control. He said that the Fed will continue to hike rates until inflation is under control. He also noted rate hikes could go from the traditional 25 basis points, a quarter of a point, to more aggressive 50 basis point increases if necessary. The Fed's more aggressive tone has sparked some fears in the bond market that the Fed will be more serious on reducing their balance sheet. That's where the problem comes in, right there. Going up on interest rates from the Fed usually will help the mortgage market, which means it's going to bring interest rates down for mortgages. Until the Fed said that they came up with the thought process when they're getting aggressive on their balance sheet, that means either where they stop buying mortgage bonds or worse, they start selling what's already on their balance sheet. So I think it's about 70% of all mortgages are owned by the Federal Reserve. I know you don't want to hear that, but that's really where the numbers are. If they start going the other way and getting rid of that, why does that have what's the effect? What's the cause for that to be on the mortgages? Why is that happening that way? Well, here's the issue. If the Federal Reserve comes out and starts increasing interest rates, that means inflation is down. Inflation is the problem for mortgage-backed securities or any bond. So generally, when the Fed goes up, the interest rates come down. Recession is generally also positive for interest rates because what's going to happen as soon as the Fed increases interest rates, as they're doing now, they'll slow the economy. They'll overdo it. They always do. The economy will fall into a recession. The Fed's going to then say, we got to help get us out of a recession. How do they get out of a recession? They lower interest rates. So instead of going slow and seeing, now it takes about 9 months for a Fed fund rate to go all the way through the market. About 9 months. So that which they did on the 16th of March won't be felt until December or January of next year. So if they raise again next month, what are they saying? Well, we don't know what happened, but we're going to raise anyway. And that's how they end up overdoing it. So that's the Mortgage Minute brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva is the program that you want. In divorce, is it intelligent to take an interest-only loan? Well, it depends. If you're taking a loan it depends if you need a loan. That's the first question. Obviously, you're thinking about it. So probably the answer would be yes. In fact, right now, I'm a big fan of interest-only loans at almost any time. Why? The rate of return on home equity is, who's got the right answer for me? There we go. Now I got the buttons right. Rate of return on home equity is always zero. Always, 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 always zero. So whenever you're making a larger equity payment, what you're really doing is saying, I like investing at nothing. So interest-only loans are good. Seeing a lot more of them coming back on the market. I'm a big believer, and we talked a little bit about this yesterday. We're going to talk more about this in the days and weeks to come. But we're going to be talking about who's overseeing your liabilities. right? You might have a financial planner working for you, but who's working for you as a liability manager? And we're working diligently right now on a couple of different programs. We're talking to one company about helping with student loans. How do we negotiate those? How do we reduce those? How do we take advantage of the marketplace on student loans? So we're working diligently on that one. Hopefully we'll have some answers in the next few weeks. We're also working on a program that I'll probably be rolling out in the next week or so. I'm just sending it out to some beta folks right now that want to see it. How do you get totally debt-free in 9 to 11 years? 100% debt-free. Not the Dave Ramsey style. That one is not good for anybody. No, I don't believe in that. So the whole idea here is the concept of reallocating your funds. Reallocating your funds. You want to find out, how do you pay it out? When you look at a 30-year fixed rate loan, should we give another quiz here? 30-year fixed rate loan. How much of your initial payment is going to principal? How much of your initial payment is going to interest? What would you be the guess here? Anybody got a guess? How about 70%? 70% of your initial of your payment on early on in a 30-year fixed rate loan is going to interest. Now, if you understand how to, I don't know, a lot of people think that if I use the word manipulate, it's negative. But what if you, maybe I'll use understand. If you're going to understand the amortization table, we can actually show you how to make 4 payments look like 10. Would that be, how'd you like to have 4 payments and have an account for 10 on your mortgage? That'd be fascinating. Would you, and how would that then affect how long it takes you to pay off your loan? Well, we're going to be doing a lot of demonstrations on that. And like I say, I've got about 10 people that we're going to let into this beta sample to show them how this works until we roll it out to everybody. If you want to be one of those 10, just let us know. Send an email, rj@ronsiegelradio.com, rj@ronsiegelradio.com, and we'll let you in on that. Little bit of a secret. So we've been getting some good questions in here from somebody named User. I've been called a user before, but I think they were talking about something different. To sell or not to sell, that's the question. That is the question. Don't want to be homeless. We should go back to this question because this is a fascinating one. To sell or not to sell, that's the question. Don't want to be homeless if I sell. I'm going to recommend buy first. If you're thinking about selling, where are you going to live? Unless, the idea here is you probably want to have a roof over your head. It costs extra, but you want a roof over your head, right? Renting or buying. Buy first because it's not that difficult to sell right now. So buying first is really a key in what we're talking about in this day and age. You're listening to Ron Siegel Radio discussing your real estate current events and the financial markets. The many benefits of home ownership, when to consider a cash out refinance. We'll talk about that. And understanding your mortgage options during divorce. All that and more. You can reach me anytime. Off-air number 800-306-1990. 800-306-1990 or ronsiegelradio.com, facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The real-time real estate segment today being brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit rsrhomescout.com, rsrhomescout.com. Find out exactly what your property is selling for. There's 4 different valuation models on the last tab. When you want to find out the value of your real estate, you go on the last tab right there in the middle of the screen, and you can put in your address, hit the little magnifying glass icon there, and they'll give you 4 different valuations, even the one that's not accurate. Yeah, that's, well, I better not say their name. They might get mad at us. But there's one of them that is the biggest in the marketplace and generally the least accurate. But it's on there too, just so you'll know what they're saying about your property. rsrhomescout.com. The many benefits of home ownership. Past 2 years have taught us the true value of home ownership, especially the stability and the feeling of accomplishment it can provide. But home ownership has so much more to offer. Here's a look at a few of the non-financial and financial benefits of owning a home. If you're looking to buy a home today, think about all the ways home ownership can impact your life. Home ownership has impactful personal and emotional benefits. Owning your home gives you a significant sense of pride because it has a space that is truly yours. And as a homeowner, you can customize your home to your heart's desire. Having a space that you've put your stamp on enhances the pride and sense of ownership you may feel. And that sense of ownership can extend beyond your shelter to help create social, community, and civic benefits as well. That's because the average homeowner stays in their home for longer than just a few years. That means you'll naturally feel a stronger connection to the community around you the longer you live there. This can help you experience a greater sense of belonging and a greater stake in your community as a whole. As the National Association of Realtors says, NAR, quote, living in one place for a longer amount of time creates an obvious sense of community pride, which may lead to more investment in said community, unquote. Owning a home is a significant step toward financial stability. In a financial sense, homeowners benefit from home price appreciation, equity gains, and having a shield against some of the effects of inflation. These benefits can have a big impact on your life. As you gain equity through home price appreciation and paying down your mortgage, you build your net worth. And in times of inflation, your 30-year fixed-rate mortgage can help you stabilize one of your largest monthly expenses for the duration of your loan. Lawrence Yoon, chief economist for NAR, explains how you can start to see these lasting effects of homeownership as soon as you make your purchase. Quote, owning a home continues to be a proven method for building long-term wealth. Home values generally grow over time, so homeowners begin wealth building process as soon as they make a down payment and move to pay down their mortgage, unquote. Knowing you've made a good investment soon after your purchase is powerful, and that may give you confidence in your decision to buy a home. Bottom line, the benefits of owning a home are foundational. As a homeowner, you can feel proud of the space you call home and know you've made a sound financial investment. To learn how homeownership can help you, give us a call, 800-306-1990, 800-306-1990. That's the real-time real estate segment brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit rsrhomedigest.com. rsrhomescout.com. Got to get it right. Maybe if we just change the forwarding on RSR Home Digest, RSR Home Scout, and then when I goof up, it'll work better. Just give you some information there. You know, there's one other item that I wanted to share with you, and we would have done this as part of our real-time real estate segment, but I didn't. Getting caught off guard by closing costs. As a homeowner, it's important to plan a budget for expenses you'll encounter when you purchase a home. Most people understand the need to save for a down payment. A recent survey found 41% of homeowners were surprised by their closing costs. We don't like surprises
Surprise, surprise, surprise.
Yeah, surprises are good for birthdays and anniversaries, and not so much for business. 41% of home buyers were surprised by their closing costs. Here's some information to help you get started so you're not caught off guard when it's time to close on your home. What are the closing costs? One possible reason some people are surprised by closing costs, maybe because they don't know what they are or what they cover. According to U.S. News and World Report, quote, closing costs encompass a variety of expenses above your property's purchase price. They include things like lender fees, title insurance, government processing fees, upfront tax payments, homeowners insurance, title fees. There's a lot that goes into that. Escrow. In other words, your closing costs are a collection of fees and payments made to a variety of individuals and organizations who are involved with your transaction. According to Freddie Mac, while they can vary by location and situation, closing costs typically include government recording costs, appraisal fees, credit report fees, lender origination fees, title service fees, tax service fees, survey fees, attorney fees, escrow fees, underwriting fees. Lots of fees. How much will you need to budget for closing costs? Understanding what closing costs include is important, but knowing what you'll need to cover to budget for is critical to achieving your home buying goals. According to Freddie Mac, article mentioned, the costs to close are typically between 2 and 5% of the total purchase price of your home. With that in mind, here's how you can get an idea of what you'll need to cover your closing costs. Let's say you find a home you want to purchase for a median home price, not in California, $350,300. Based on the 2 to 5% Freddie Mac estimates, your closing fees would be between roughly $7,000 to $17,500. Keep in mind, if you're in a market for a home above or below this price range, your closing costs will be higher or lower. What's the best way to make sure you're prepared at closing time? Freddie Mac provides great advice for home buyers, saying, quote, as you start your home buying journey, take the time to get a sense of all costs involved from your down payment to closing costs, unquote. The best way to understand what you'll need at closing table is they work with a team of trusted real estate professionals. An agent can help connect you with a lender, and together they can provide you with the answers to the questions you might have. And the bottom line, got to understand these things. There are services that many of us have that we can actually just tell you what the fees are going to be on a projected basis. So just giving you a whole idea right there is knowledge. That's what we want to have, is the knowledge to make these decisions, the knowledge to be informed. I especially our younger buyers, first timers, they don't know. I had a young person on it. Josh, I don't know if you went through this, but you've got family in real estate, so maybe not. Right? So here's the issue. People think, well, my closing costs are going to be, I take the price I paid for the property, let's say for a round number, $500,000. And my down payment is $50,000. I give a earnest money deposit of $10,000. So, okay, my closing cost is going to be $40,000, right? The $500,000, I'm getting a new loan for $450. You're putting down $50 and you already paid $10. So you got $40,000 left to close. And then they get to the closing table and they find out we need a check for $60,000. And you've got this, oh no.
What's the big idea?
Yeah, what is the big idea? Confusion. Why? It shouldn't be that way. The reason that happens is because you did not get the education up front. Maybe you went to a headset lender, right? Maybe you're trying to buy online, or maybe you're trying to buy from a for sale by owner and you're not getting the information you need. All normal things that happen every single day. But there's apps that we get from the title company that you can just go in there, put the purchase price, put the interest rate, put the amount of the down payment, type of loan, and it'll spit out what all the closing costs are: title, escrow, recording fees, transfer fees, you name it. There's probably 10 of them. And then okay, my down payment is $50,000. I have to add another $7,000 for costs, $57,000. I already put 10 into escrow, $47,000. Now I don't have the surprises. Here's the other one. Are you closing on the 1st of the month or the 31st of the month? Your cash to close will change based on that. Why? It's called interim interest. Interim interest. So you're always going to pay your mortgage payment, or just about always, is due on the 1st of the month. But you're paying for the prior month. In rent, you pay ahead of, you have to give your landlord your money before your rent, before you live in the property. On a mortgage, you're paying your interest, you're paying your payment after you've already lived there for a month. So the interim interest is the amount of interest from your closing date until the 1st of the following month, because you're not going to be making any payments there. Then your payment is due after that. That's pretty confusing, Ron. Let's explain that a little better. So today is, if you're listening to us live, today is the 22nd day of the month. And yes, every month has 22 days. Some have even more than that. But today's the 22nd day of the month. There's another 9 days left in this month. So your first payment is not due the 1st of next month. It's due the 1st of the following month. So your payment covers the interest from the 1st of next month through the last day of that month. It's due the 1st of the following month. Yes, I know most of them will give you a grace period till the 15th, but it's really due on the 1st of the month. I digress. So we've got 9 days worth of interest. That's going to go into your closing costs as your interim interest. So if you've got $20 a day, and it's going to be all the way to the penny, they're not going to give you a break, $20 a day of interest on the new loan, well, you're going to have $180 of interim interest that gets put into your closing costs. It'll be on your closing statement. So there's where those numbers are coming from. Just giving you a little bit of an idea there. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. When we come back, when to consider a cash out refi, and we'll also talk about different types of mortgages in a divorce. You can reach me anytime. Off-air number 800-306-1990, 800-306-1990, or ronsiegelradio.com. Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube. Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions, as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Your Credit Matters segment today being brought to you by creditsanitizer.com. You have a credit report. It's wrong. They all are. What are you doing about it? My opinion, I've never seen one that's completely accurate. Never. And I know that there was an old 60 Minutes that said about 20% of them have errors. I'm going to say I would love to see one of those 80% that they say has no error. Maybe it's not material or something, but they all have errors. When to consider a cash out refinance is the question. Cash out refinance loan can be a great way to tap some of the equity in your home. However, the costs associated with this type of mortgage loan may give some homeowners pause. If you have a significant amount of equity in your home that you're hoping to use to pay off high interest credit cards, make some in home improvements, or just about anything else you can think of, here's what you should know about a cash out refinance. Cash out refinance is a mortgage loan that replaces your existing home loan, complete with new terms. Unlike a traditional refinance loan, however, A cash out refinance loan allows you to take cash out of your home's equity on top of the original loan amount. For example, let's say your home is worth $300,000 and your mortgage loan balance is currently $100,000. If you're thinking of making home improvements to your home that'll cost $50,000, you could use a cash out refinance to effectively take that amount from your home's equity. The new loan will combine the $100,000 balance paid off and the original loan plus the $50,000 you take out in cash for a total of $150,000. The lenders typically require that you maintain at least 20% equity on a $300,000 home. That means your cash out refinance loan cannot exceed $240,000. That limit can vary. Cash out refinance is the only way you can tap your home's equity. Here's how to compare home equity line of credit, home equity loan, cash out refinance loan versus the home equity loan. Both of these loan options give you a lump sum amount up front, which you'll pay off over a set period determined by you and your lender. That said, a cash out refinance loan is a primary mortgage loan, which means that you're only borrowing money from one lender. With a home equity loan, you're taking out a second mortgage from a lender that may not be the same as the one that services your primary mortgage. Instead of one monthly payment, you'll have two. Additional home equity loans are referred to as subordinate loans. This means that if you can't make your payments and the original lender forecloses on the home equity lender only gets paid if there's enough money left over after the original lender sells the home and recoups its loan balance, interest, and fees. As a result, home equity loan interest rates tend to be a bit higher. That said, closing costs on home equity loan are only applied to the amount you're taking out of the equity, whereas with a cash out refinance, you're paying closing costs based on the cash portion and the original loan amount. Some home equity loans may not charge closing costs at all. Cash out versus a HELOC, a home equity line of credit. With a cash out refinance, you're getting a lump sum payment that you can pay back over time. In contrast, a HELOC gives you a revolving line of credit that you can use, pay off, and repeat, similar to the arrangement you have with your credit card companies. A HELOC can be worth considering if you want to access the funds over a long period of time rather than all at once. You'll have a draw period, during which you can take withdrawals for anything you want and pay only interest on what you've borrowed. After that, the repayment period kicks in, during which time you'll make regular monthly payments over a set period on whatever balance remains from your draw period. Another key difference between the two options is that cash out refinance loans can come with a fixed or adjustable interest rate, while HELOC interest rates are almost always adjustable or variable. This means that the rate will fluctuate along with market rates and can ultimately cost you more money. HELOCs may also come with an annual fee, but some don't charge closing costs, giving you fewer upfront expenses like home equity loans. HELOCs are subordinated loans, so they may come with higher interest rates than the cash out refinance. Pros and cons of each of them. If you're considering a cash out refinance, it's important to understand both the benefits and the drawbacks. Here's what you should keep in mind. Pros: potentially lower interest costs. You'll generally get a lower interest rate on a cash out refi compared to a home equity loan or a HELOC, and you might be able to get a lower rate than what you're paying on your existing mortgage loan. Access to funds, having a lot of equity in your house is a good thing, but unless you have plans to move soon, you can't access that money without using a cash out refinance or home equity product. If you have some significant expenses coming up, it could save you money compared to a personal loan or a credit card. What's more, there aren't really any restrictions on how you can use your cash out refinance funds. Simplicity: unlike with a home equity loan or HELOC, you'll only have one loan and one monthly payment. The cons: potential for higher monthly payment, closing costs, potential for private mortgage insurance. How a cash out refinance impacts your FICO score: well, you're going to get a credit inquiry, you're going to have a loan payoff, you're going to have a new loan, you're going to have more debt. That's part of it. Should you consider a cash out refinance? It's a good thought. I'm going to share with you. Yeah, consider that cash out refinance and have it as part of your strategy. Cash out refinance is more expensive than a rate and term refinance. But here's the beauty. Do the cash out refinance now, even though rates are higher. You might even want to increase your interest rate to cover those closing costs and build that in. And then as interest rates come down in a year from now, you're ready to do another refinance and it's not considered a cash out at that time, and you're going to get a lower interest rate. So that's going to help you out big time. Just a thought for you. That's your Credit Matters segment brought to you by creditsanitizer.com. You have a credit report. It's wrong. What are you doing about it? So let's take a look at this one. Not really one of our normal better outcome segments, but we're going to call it that anyway because we're going to put it on our archives in the better outcome segment. Understanding your mortgage options during a divorce. Divorce is never easy. It's often painful, complicated, something that most people just want to get through. Whether you're legally separated, getting divorced, or already divorced, you may need to remove your ex from your mortgage and assume the loan on your own, and you may be wondering what your options are. I'm going to share some simple tips to consider if you're going through a divorce. Often, in a divorce, the spouse either agree to sell their home or refinance their mortgage so that only one person's name is on it. If one spouse is going to stay in the home and not sell it, you'll have to agree to what will happen with the mortgage. The divorce agreement will then spell out who is responsible for paying the mortgage. Perhaps you want to make sure that your ex is no longer financially responsible for paying the loan. If you have both agreed that you'll keep the house, or you might want to make sure that your ex won't get any of the proceeds if you sell the house, or they don't inherit it if you die or when you die. No matter why you're removing your spouse from your mortgage, you'll have to follow certain steps intended to protect you, your ex-spouse, and the mortgage lender. Here are some shared questions that come up regarding the mortgage and divorce, beginning with, can I remove my ex's name from the home and the mortgage? First, you need to understand that removing a spouse from a home, also known as title, and removing them from the mortgage, like a refinance, are two completely separate tasks. Many look at title and mortgage as being one and the same. They are not. You can remove your ex's name from title, yes. In fact, in instances where one spouse has agreed to take over the house as part of the divorce settlement, it's wise to have the former spouse's name removed as quickly as possible so they legally won't get any of the proceeds if you sell the property or inherit it if you pass away. Removing one party from title does not, however, remove them from the current mortgage lien, assuming the loan is in both of your names. The title transfer is accomplished through a simple grant deed or interspousal deed. The same cannot be said for the mortgage, which requires one spouse to qualify for a new mortgage on their own. Let's take a look at those steps, beginning with taking your spouse off of the mortgage. You'll most likely not be excited about this news. There's only one way to have your spouse's name removed from the mortgage, and that's to apply for a loan to refinance the mortgage in your name only. Why? Well, your existing mortgage was approved with both of your names, giving the lender two sources of repayment. Although you and your ex may decide between yourselves that only the person who is getting the house will be responsible for paying the mortgage, that agreement does not affect the lender. In other words, the mortgage lender can still come after your ex or you if your ex is getting the spouse for repayment if the payments are not made unless and until you refinance in your own name alone. This means that while you may not be living in the house, you could still have it affect your credit if your ex decides to not make the payments. Something to consider on both sides. You will have to complete a new mortgage application and qualify on your own for the house. You'll have to prove that you'll be able to make payments on your own. The lender will look at your income, assets, debts, and credit score. If your credit and financials are not strong enough on their own to qualify for the loan you need, you'll have to produce other options, such as making a larger down payment or asking someone to co-sign the loan for you. Removing your ex from title. Next step is remove your ex from the title. This is typically done through a quitclaim deed or an interspousal deed, meaning that your ex gives up his or her rights to the property. This deed is then filed with the county clerk's office, and title of the property becomes updated. Sometimes it makes sense to refinance this loan pre-divorce prior to the judgment or dissolution going into effect. Oftentimes, the refinance is done prior to any settlement agreement being put together. If you're updating title to a home in a divorce while still legally married, you will need to hold title as a married man or woman as his or her sole and separate property. Then, Once the divorce is finalized, you can file another deed changing title from your sole and separate property to an unmarried man or unmarried woman. These are just a few of the important processes and timing considerations associated with the division of property. Should I allow my spouse to have exclusive use of the home if I'm still on title? If you agree in a divorce settlement to give your spouse the home, ideally they'll refinance the home mortgage in their name only. This will provide reassurance that you no longer have any financial responsibility, and then will be able to confidently sign over title to the home. The exception to this is easy for me to say. The exception to this is if there is a deferred distribution whereby both parties agree to maintain possession of the house until such time that a court orders the house sold, usually when there are no longer minor children living in the home. What are the risks of not removing the X from the mortgage? A couple of primary risks. Credit could be affected. It could be hard to qualify for a new home loan. The divorce settlement agreement might state that the retaining spouse, the in-spouse, is responsible for all mortgage and housing expenses, but the credit bureaus do not care which party the property was assigned to. If you are co-signed on a mortgage with your ex-spouse, from creditors' point of view, you have agreed to keep up timely payments. In the event that a payment is missed, this will be reported directly to the 3 credit bureaus, which are Experian, TransUnion, and Equifax. What happens if you want to buy a new home? Several items to consider. We don't have time to go into all of them right now, but you can go to mycdlp.com. We share all of these things there. And we also have the My DYM workbook. That's Divorcing Your Mortgage workbook. My DYM workbook, mydymworkbook.com. And you can get that information there as well. And as always, I ask you, set that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A very big thanks to Josh and Sean who are engineering us today. And of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.